Hi, I'm here with Bill MacDonald. Bill is CEO of Mill Creek Residential, a national multifamily company, and a good friend and long-term client. Good to have you with us today, Bill. How are you?
I'm great, Gadi. Thanks. Thanks for having me.
Absolutely. It's a great pleasure. So, where do we find you today?
I am in Bethesda, Maryland, at our office up here. I started in Florida actually when this whole thing really hit the fan in mid-March. Rachel and I were in Florida. We were first-time empty nesters, and then of course the kids get kicked out of school and they all have to come home and finish online. So then we left Florida and came back to Maryland, and we've been up here for the last 2 months. But I've been coming to work every day in the office. It's nice and quiet, and get away from the house, so it's great.
That's good. You're one of the few people that, in spite of the conditions, have actually been going to the office. Are you the only one in the office, or are there other people that are also choosing to go in?
The first couple of weeks, Scotty, it was really just me, and then maybe one other person. And each week, a few more come back. So, probably the maximum in our office on a given day is, 6 people, 7 people, maybe, out of 25. The building itself, though, there's 2 buildings here that maybe have 800 people total. My guess is there's 20, 25 people out of 800 that are here at any time. Not a lot.
It's like going to work on Christmas Day, right?
It is.
Nobody around. Well, terrific. So, Bill, we've been at this pandemic now officially with shutdowns and disruptions clear and evident for at least 2 months now. So Mill Creek clearly has seen the signs and then had to deal with the realities. I think we hear so much information about collections and performance, so I think there's no point in kind of going back and restating what is already pretty well known. But what have you found, what have you done uniquely at Mill Creek over the last 2 months to identify strategies and deploy them in dealing with the pandemic, and how have things worked out relative to what you were hoping they would have, given again the unprecedented situation?
Yeah, it's interesting. Some of this is unprecedented, clearly, but then other aspects of it, at a much higher altitude, are not too dissimilar from the way one would approach, running a company and a business from the early 90s, 2000, early 2000s, the great financial crisis, to today. The unique aspects were the complete shutdown of some markets, right? People afraid being in public near each other and all those things. So we had to adapt pretty quickly. We managed 72 communities around the country. So early on, we realized that, we weren't going to be able to keep up with the cleaning and the distancing and monitoring that 24/7 as was really needed in the early start of this. So we closed down a lot of our all our amenity areas in our communities. A lot of our staffs weren't on site, or we had a skeleton staff. We adopted to move to virtual leasing, which we have done obviously in the past, but primarily it's been an in-person type of endeavor. So we switched to that. So on the operation side, there were a lot of decisions to be made. We made those early on and quickly, both to protect our residents and our associates. So that was different than any other previous situation we've been in, or downturn. On the construction side, we have 31 communities under construction around the country. Every day was different. You had some subs not showing up, some coming with half crews. You had municipalities saying, we're shut down, you can't come. And then the next day they say, oh no, well, wait a minute, you're an essential business, you can come. And we have to communicate to all the subs and the suppliers that we are essential, you can come. So it was a lot of moving pieces there, but interesting. But we, kept moving forward. The trend was good. We really only got shut down in 4 different markets out of the 17 major markets that we're in. And of those 4, only 1 was more than for longer than a week and a half. So a lot of the similarities are just, communicating really well with your teams, your investors, your lenders, your residents, making sure, cash is obviously king, being in a good position and not panicking.
If you had anything to do over again over the last 8 or 9 weeks, what would you have done differently if you could?
Probably seeing this, we made some cuts in overhead pretty early. We haven't furloughed or laid off anybody, but we made meaningful reductions in payroll and other overhead. So, I guess, we maybe could have started that a few weeks earlier. One thing that in hindsight, I wish I didn't do is we had a big company meeting, as you know, in Nashville in March, 12th, 13th, 14th, and that's right when everything hit the fan. In hindsight, I wish we didn't have everybody there because I think it stressed a lot of people. Thank goodness we've only had a couple of people in the company out of 1,000 people that have gotten the virus that we know of. Nobody from that meeting, so that's all good. But there's nothing that jumps out that says we should have done this differently, other than I think we maybe should have closed some construction starts, tried to push to close those a little earlier because debt as we go on it's getting a little more problematic. So maybe a bigger push to start a few new deals early.
So you're pretty optimistic about what's happening. You're prepared to continue funding construction, start new projects that are already in the pipeline. You're not going into a defensive mode that says, let's ice everything, let's see what happens, and we'll come back to it in a year from today. Why?
Right. Well, first, when we came into this, right, much different than the great financial crisis, we came into this, the multifamily space, right? We were undersupplied. We had low leverage versus the last time around. Pretty much everybody did. Very low interest rates. We had low cap rates. We had strong operating fundamentals. So we felt good going into this. It happened. We adjusted. The biggest issues for us are really just the timing of completing construction. It's gotten longer, right, because of the stops and starts and distancing and whatnot. And sales have frozen. But new business, new development, we look at it and, look, rents are going to go down this year. They're already starting to go down. So they'll go down in 20 in most all our markets. We think in 21, they'll go down in a handful of markets, but most of them, they'll be positive again. And then in 22, all of them look like they'll be positive. Now, who knows? If this thing just gets worse and worse and worse and it's a deep, it's a big U and there's a big bottom to it, then obviously, then we're wrong. But we don't think that's going to happen. And so we look at it and say, if you're building now and therefore you're delivering and leasing in late, in late 22 and then into 23, we think that's a really good sweet spot. We think some deals are going to get just put aside and they won't get started because folks are undercapitalized and they didn't have equity lined up. They don't have strong balance sheets. So because, the lenders and investors are going to be more choosy than normal on, who they go forward with. So I think there'll be a, lower supply, rents will be coming back, people will be leaving mom and dad's house, going back, looking for apartments, demand should be up. For sale, there's different thoughts on that, but for sale is probably not going to kill it. They may do okay, but they may not do so great, so we think it's, we're kind of bullish about delivering product in late 22 and into 23. And then if you look at the value side of that, with rents going up, interest rates being so low and likely staying low, values probably going up and cap rates maybe coming down again because of alternative investments. People are going to put money in real estate and, less dollars are going to go into some asset classes in real estate. And that money that will go into real estate will then be reallocated to other areas. And we think multifamily market rate apartments is going to be a place that will benefit.
So I get your underlying assumption or expectation about what happens on the other side of this. And also I get a sense that your outlook is predicated upon a base case that the worst is kind of like behind us and that from here on out, there's maybe a few more months of decline in economic and business activity for your company, but by and large, by second half of this year, sometimes second half of this year, we'll start climbing out of the hole, and that's going to persist through 2020 and 21 and beyond. And may take a while to regain the grounds that we may have lost since February of this year, but that's the trajectory. So with that in mind, and I believe that you are not one of those who may be forced to transact when you don't wish to. So there's got to be an expectation, Bill, that you have for where property values sort of settle down. If you took February 2020 as the high level watermark, by sometime after the dust settles, let's call it late summer, maybe fall, where do you think values will end up being? You talked about compressing cap rates, maybe lower interest rates, but different NOIs given more operating costs perhaps, and certainly lower rates. So what do you think happens?
Yeah, certainly values right now, as you're indicating, right, have taken a hit, plus or minus 10%, most likely in the multifamily space. Look, who knows really, but I don't think that will return to the February levels, in my opinion, probably till later this year. Now, if later this year there's a relapse, then you're going to hit the hold button, pause button again. So so it might happen by the end of this year, but my guess is it's more likely will be this time next year, not so much a big pickup this year.
Yeah.
I think sales are going to be lower than we expect at the levels of pricing that we had in February until next year. Now, it only takes one to think differently on the buy side, right? So we'll see. But
right. Well, the question is really more on the sell side, right? Who's going to sell and why are they going to sell? And what is your outlook for that by, for fall and second half, if you will, 2020? Who are going to sell? Who are the players that are going to be selling, and at what price are they going to be selling, given how much capital is looking to make investments, and perhaps how many or how few transactions are going to be available? What do you think?
Right. Well, first, I think there'll be fewer people selling this year than normal, simply because of the gap that's out there and the buyer's expectation of getting a deal. Much like we all got, back in 2008, great financial crisis. I don't see that happening as much here. There'll be some of that, but not as much. And so where it will happen, my guess is it'll be on apartment communities that were financed with mezz debt, where the seller or the sponsor is getting buried and behind all these prefs, and with lower NOI, like you said, when they look at time, even if the values go back up in a year to what they were in February, they're going to do the math and say it's better for me to sell at a discount now than to hold this for another year and a half, and sell it even at a higher value. So I think folks, depending on how they financed it, what kind of prefs in front of them will sell. Others that just need to get cash for other parts of their business, where they have, maybe they're also into hotels or retail or gaming or some other type of business, and they need to, patch some holes in the dam somewhere else. So let's take something that is somewhat marketable, even if it's below what we think we can get if we hold it for a while, and use that money elsewhere. So I think those will probably be the sellers. Otherwise, I think most people will hold out and wait, because they have lower leverage than typical, and they do. And again, coming into this, we were in a great spot fundamentally as an industry, and so I think most people will wait about.
That's a great summary, Bill. So you expect that institutionally funded projects are not likely to go to market because institutions are not going to be anxious to take a discount, and the sponsors, even if they had a say, probably would be happy to kind of ride along and wait, maybe not for as good an IRR, but hope for as good or better multiple by delaying the transaction. But where the opportunities might be would be in more privately capitalized projects, not institutional capital, perhaps with higher leverage between first and maybe mezz debt, or construction loans that need to be refinanced or taken out, but the takeout is not available, at least not with the proceeds that were hoped for, and that needs to be structured. So it seems like there's a big haystack of
I lost you there, Gadi.
developments and assets out there. We do have some timeouts every once in a while. Am I back now?
Yes.
Okay, good. Sorry about that. So you don't expect any wholesale distress, at least not today, based kind of things of the style of the 1990s, the or the GFC.
Right. Yes, that's what I expect. And the banks are much more forgiving right now than they were back then. I think there's more liquidity in the market. They know multifamily, as an asset class is in a better position than either their other asset classes, so they're spending their attention there. The government's not coming in, and the regulators are pushing them as hard as they did back in the financial crisis. So now, if this thing goes on longer than we all expect, and it doesn't come back up, then at some point, banks will start to get antsy, and there'll be some things that'll shake loose that might be great opportunities, but haven't seen it yet.
The game will change, no question about that. I'm curious about your point of view, maybe even analytics. Do you have any idea how much of your tenant base that is paying rent now is doing so with the help of PPP and maybe other stimulus? And do you have any anxiety about what happens over the next 60 days as the PPP money dries up and maybe people begin to get laid off or not have money to pay their bills?
Yeah, PPP in particular, we don't have statistics on that yet. We've been talking about trying to figure out how we can, we can access that and ask people. Our collections, as a side to that, our collections in March were about 96.5%. So obviously much higher than, people thought. April, it was 94.6, and then in May, it was 94%. So very strong. We've only had, best we can tell, our residents we've had, in our newer product, the product that we've developed, 4 or 5% of the people in our communities that have been furloughed or laid off. That's what we've been able to ascertain so far. As you would imagine, brand new, A quality product, it's higher rent on average. Our rent's plus or minus $2,500 a month without parking and some other miscellaneous charges. So pretty high income folks in our communities, and the percent of their income that they were paying for rent was about 22.5%, 23%. So they were making really good money, and those folks don't seem to be, at least so far, the ones that have been furloughed and laid off, at least in our communities. So.
Yeah, I think it'll be interesting to watch that. We'll see what happens, of course, with all these patterns. And the flip side of it is that if the economy does roar back, whatever roaring back looks like, the reemploying of the 40 million that have been laid off and elimination of potential further layoffs for those who are still employed will be a blessing. It'll be great to have. So you've been playing a lot of defense. You've been working with your residents and your team members, and you've been working with your lenders and equity partners. What are you doing offense-wise? Are you seeing anything? Are you giving even any time to look at it? And if you are, what are you exploring? What are you hoping to see, and what is coming out?
Mm-hmm. Well, first, on being on the offensive side, for our pipeline that we have 46 communities in our pipeline right now. The total is about $5 billion in total capitalization. So one of the first things we did, and this is one of the things that's similar to the other several since back in 1990, the three other big downturns that we've gone through. We go back to the land sellers and we say, look, the world has changed, which it has. It's easy for them to see. And we try to get reduction in pricing on the land, and we get more time. So it's in effect that's defensive, but it's offensive in the sense that it allows us to then hold on to assets that we think make sense, as I said earlier, to then build, close, and then build and deliver into what we think will be great markets in 22 and 23. We go to our architects or engineers, and we ask them to help out during this also, and we ask them to reduce costs, also, or to we pay less money right now, and if the deal does go forward and close, then we'll pay them the balance later. We're working the construction side of it hard. There's opportunity there to be offensive again in this pipeline, buy other deals that don't go forward. Subs who thought they had work, now they don't have that work. Now they want to keep their people busy. Margins start coming down. Material prices come down. So the offense part is trying to hold on to the pipeline, the $5 billion pipeline we have, with reduced costs, work on reducing those costs, and then delivering into a market in 22 or 23 when we're releasing where rents are back higher than they are today with, still low interest rates and hopefully great cap rates. The other offensive piece is just keeping in the market, all our local markets, and understanding what our competitors are doing, if deals are getting dropped, if there are opportunities to jump in, whether it's a land opportunity, whether it's a site under construction that they can't finish for some reason, and or acquisitions of existing, BC product. So that's the offensive piece. And so, we have cash available to do that. We have a strong balance sheet. We have a great capital partner in the Arizona State Retirement System that allows us to look at things like that.
Are you finding construction costs coming down in a measurable way?
They are coming down. It's depends on market right now, market specific, but the trend is certainly down. Pricing on materials is coming down. Some are going up a little bit because while the demand is down, then people are shutting plants. So then they're cutting some supply, right? So, but net costs are starting to come down, not significantly yet. There's got to be a little more pain for the subcontractors and some of the suppliers. But over the next couple of months, I think the trend will continue. It'll start to speed up a little bit. That's what typically happens. I don't imagine it would be much different here. So, and land prices on new opportunities takes a while for land sellers to readjust their thinking. They're going to try to wait this out a little bit. You just have to, keep pushing. But, eventually that they react also, but it's a delayed reaction.
It'll be interesting to see over the next 60 days how, as you re-underwrite the deals that you have, redo your business plans, and look at new opportunities, how these fundamentals have to change to make economic sense for investors. So to that end, you as CEO, people look up to you, your investors, your partners, your employees, even your residents and others. They all look to you for wisdom, for guidance, for direction. I know you're very comfortable with that, but I also know that you've got to get your information somewhere. You got to be talking to somebody or reading things, or I'm curious about how, as a personal insight, where do you get your information? How do you process it? And how much confidence do you have in that information?
Sure. Well, first, I try to read as much as I can from any source. National Multifamily Housing Council, Green Streets, Witten, PRIA, Institutional Real Estate, obviously RCLCO. You guys put out some great pieces, have some great seminars.
Thank you for that.
Yeah, you guys do that every week now on Fridays. We have our folks that go there, and if I'm not on, then they take notes. I talk to a lot of different folks in the industry that are competitors, but friends, not just in the multifamily space, but in other product types. Read all kinds of banks and investment banks and placement agents and their economist reports. Listen to Peter Linneman, haven't listened to Peter in a while. So it's really just trying to get as much data as you can. A lot of it ends up being somewhat similar. There's some outliers out there, but generally you seem to get somewhat of a consensus over time, and that helps at least me develop some opinions, about direction.
So among the key decisions you got to make, what are the ones that you find that you have to make, but you feel like you have the least information about?
It's timing of when people will start traveling again, when people will be able to, therefore, will come and lease in person. People will leave their home to go rent an apartment again. When people feel more, with these job losses every week now, it's 2.5 million people, as you said, it's almost 40 million now. So when do those job losses stop? When do people start going back to work? When do inspectors start coming back out to sites and inspecting? When do building departments, start working more regular hours to review the plans for new opportunities you have? When will the equity investors, come back and say, okay, we have the money and now we're ready to actually invest it again? When will buyers show up and the buy-sell gap narrow enough where they're comfortable to underwrite and the NOIs aren't as foggy as they are today? So it's, so the biggest unknown are all those things, and they're all connected to, obviously, if there was a vaccine all of a sudden created and we could distribute distribute it, in 3-4 months, then that's nirvana. I don't expect that to happen. I think things will organically just get better, and we'll be kind of in a, instead of a V or a swoosh, I think we'll be in kind of, I call it a double check, where the first check is deeper than the second one, but we'll have that. So it's something over time. So the unknown is just when will people go back to quote some normalcy that we experienced pre-COVID, and that's the biggest unknown. Right?
But I sympathize. I think you have you're going to have a, sorry about that. You're going to have a set of decisions to make in the not too distant future, I'm sure, about getting the house again, right? Kind of restarting the pipeline, and it'll be interesting to see how and when those decisions come up, how you make those choices. Let me ask you another question related to that to some extent. You said, at least I deduce that you said that there will be some sort of a new normal that we're going to settle into in maybe 21, maybe 22, but sometime in the next 2 years, we'll settle on some new normal. I'm curious, in your view, what's different in that new normal from the old normal? What will fundamentally be different in the multifamily business and how people use apartments, how apartments are built and managed, how capital flows in and out of them, what roles MCR plays in all that? What's the new normal difference between 2019 and 2023, say?
Yeah, I think from an operations perspective, first, I think virtual leasing is going to stay in a big way. I think there'll hopefully be a sea change here, a shift. I mean, personally, I've been wanting for years for us to figure out, with all this great technology that we've had over the last decade or and a half, our on-site overhead payroll really hasn't changed, right? And we've talked about this before ourselves. Right. Everybody expected that to happen, but it never happened. So maybe this is an opportunity to test that, and maybe virtual leasing can take off, and we can reduce some on-site personnel to help the NOI, go the other direction and help, reduce expenses and increase NOI. So I expect that to happen. I think that'll come out of this.
So sort of accelerating trends that have already been in the works, right?
Right. And now the people are forced. Yeah, now the people are forced to do that, and they're saying, hey, this works pretty well. I see people sticking with that. Now, there's always going to be a balance, but I see that happening on operations. I think, on the ops side, cleaning and some, the way that, you have to approach that more often, different types of products. That's going to have to, be a forever thing. Construction, I think, again, cleaner, safer sites, that's a given going forward. More distancing when folks are on site working, that's going to happen, I think, for a very long time. And both of those equal longer construction time. So I think that's going to change for a good amount, looking forward for years. It'll take longer to build the same thing. I think virtual inspections will likely pick up, just like virtual leasing. So we're doing a lot of virtual inspections now. Right. I think we'll see more and more of that. I think you'll see changes, the supply chain in construction. I mean, I know, we're looking at and have, spent a lot of time thinking about not getting products from China if we can help it, or getting products that rely on components from China. That's been proven to be problematic, right? So I think there'll be supply chain changes. I think an increase in offsite assembly, again, that trend will continue. An increase in R&D by folks, looking into robotics. We've all seen videos of robots laying brick and drywall. I think people now will really start spending more time and effort on that, and I think you'll see those trends. On design, I think you'll see changes for more people. Assuming more people will work from home, and all that goes along with that. Whether it's back, it's deja vu all over again, providing spaces in one's apartment home for their own personal office. We used to do that years ago, and we got away from that. So do you do that? Do you have some larger floor plans to go along with the smaller floor plans for the better, price per month check? I think less retail. Retail for a lot of folks was a darling with mixed with multifamily. We have a fair amount of that, and I think some of our folks got really excited about retail. I think you'll see less retail going forward in multifamily communities to the extent that developers can't have less retail and it's not forced upon them by municipalities. And I think municipalities may not force as much as they did before. And then the type of retail that you have, I think when you do have retail, will be different and will be thought about and planned differently strategically than we're doing today. You won't have as many restaurants and bars as you do now. And transit sites going forward in design. Typically a mass transit site, costs a lot more money and rents are a lot higher. Will that be the case going forward? I'm not so sure it will be. I don't know that I'd want to pay a lot more, a big premium for a transit site right now, or even in the next couple of years. So I think you'll see changes like that, but I don't expect to see a radical change otherwise in, everybody running to the suburbs versus living in urban areas. I think there'll still be a nice mix of both. I think there'll be a nice mix of people that will want to rent a single family home and people that will want the multifamily. So I don't see radical changes otherwise there. I think people's behaviors will generally over time, be pretty similar to what it was before this.
Yeah, the two things that I found very interesting, I want to drill back onto with you that you said were not one, that work from home will end up increasing and then driving what space demand people have. And I'm sure you didn't mention, but I'm sure you also are considering increasing bandwidth and all the stuff that goes along with supporting that. But in the physical plant, now people need a home office and a proper home office with a door and a window and and so on and so forth. So that's more square footage per resident, I would think, right?
Right.
And you didn't say that you'll solve for that through a common WeWork or any kind of a common working place or even a repurposing of the retail space. You simply went straight to a larger unit and more functioning unit. Did I get it right?
Well, I didn't say the things you just said, but that is part of the solution, right? I mean, you'll make some changes to the apartment home itself, but again, I don't think you're going to see radical changes. We wouldn't plan radical changes. We're not going to all of a sudden just blow up our one bedrooms or our two bedrooms or our studios, because at some point people have to. Affordability is important too, right? It's always going to be important. So I don't see radical changes there. Little changes. I think you'll see more changes in the use of common space, like you said. Instead of retail, you'll have more live-work opportunities and offices or WeWork type of setups. Absolutely, and we'll provide that for the residents. And obviously, you have to put together schedules, and when people can schedule those, you have to clean those properly, and all those different things. But that's going to be a big part of going forward for sure. So people can work quote from home, but when I say from home, it may not necessarily be in their apartment.
Okay.
Maybe something that may be going out of their apartment, but still in the community.
Well, that's an important clarification, and thank you for expanding upon that. The second thing you said that I found interesting was transit. It seems embedded in your thinking that
Nope, I lost you, Gadi.
The attraction of it, and I kind of wanted to explore that with you. Do you think that is more than a temporary reaction? I'm sorry, I think I timed out. Can you hear me now, Bill?
Yes.
Okay. So I was saying that the other thing that surprised me in what you said, or at least I wanted to unpack with you, was the de-emphasis on transit. For the last 10 or 15 years, we've been talking about how people wanted to live closer to transit so they can use public transit to cut commute time and increase convenience, increase densities, et cetera, for quality of life. You seem to be thinking that may not be as much of that pattern may reverse. And I wanted to make sure that I got it right and to explore whether you think that's more of a temporary solution, reaction to the situation today where it's scary to get onto a subway or even a bus just because of the risk of infection, et cetera. Or do you really think it's a permanent change? This is not going away.
I don't look. I think for a few years certainly it's going to be a meaningful change. Long term, I think people will start reverting back to the mean, to the norm, what happened prior to the virus, until the next thing happens. So I don't think it's long term, but I do think there are some people that have gone through this that long term will think that way. It's a certain percent. I don't know what that is, but it's more than zero, and it's probably more than 1%. But there's, as we have a number of residents now that are older, the baby boomers, if you will. I'm not so sure that those folks, maybe before they would consider living at a mass transit spot, I'm not sure that they will want to, given their age, put themselves in that situation. And therefore, those folks are a fair number of those folks, percentage of those folks, will look at that type of location and will consider something else instead. Now, there's still probably plenty of demand, though, from people that are younger, they're just coming up, and over time, they won't even remember this. And so, look, there'll always be demand for that. But I'm just saying, I don't see a big premium for that for the next few years. And I think longer term, the demand may not be as high as it was historically because of what we're doing. But is that 10% difference? I don't.
So it's probably more on the margins than necessarily a ground shift.
Right.
What do you think is going to change in the investment landscape? How investors look at the type and location of multifamily and the multifamily space as a whole? Is that changing in any fundamental way? Once we're on the other side of this wave.
Well, again, prefacing it that multifamily, for their portfolio, multifamily apartments have done really well relative to other product types. I mean, there's some that have done great too, right? Industrial, manufactured housing, single family housing. But I think some will react, in the short term and say, my gosh, should we be in urban locations? Should we be at that metro location? Shouldn't we be out in the suburbs? So I think there'll be some of that for a while. I think that will calm down and it will go away. I think people, so I don't see, there'll be a lot of questions. Are you going to change your product radically? Are you going to make bigger apartments like we were talking about before, so people have an office in their apartment? And we're going to say, well, geez, we're not sure. We don't think people will pay for that. It may be a short-term fix, but longer term, that doesn't make sense. So I think they'll have a lot of questions to start with. There'll be a size of the homes, and there'll be a conversation about urban, suburban, transit-oriented spots. But I don't think there'll be a lot of conversation or consternation on their part about the space itself and wanting to continue to invest in multifamily. They may ask in the short term, what's going to happen with rents in this particular market? When do you think they'll come back? But I don't see a big upheaval.
So if we were sitting here in 2030, looking back on the last 10 years, between 2020 and 2030, do you think that there will be a substantial shift in where the demand is going to be strongest for multifamily rentals? You now have 17 markets. I think you selected them because you think that's where they are going to outperform the other, 33 top 50 markets in America. Will that list get longer? Will it go from 17 to 25, or will it go from 17 to 5 or 10?
Yeah. I think it's going to stay about the same. I don't think there's going to be a huge change or shift. I do think, again, people are going to, there'll be big changes for this year, a little bit next year, depending upon if this comes back again, it may stretch out further. But I think long-term, 2030, younger people are going to want to be where the action is. They're going to want to be near their, offices, bars, other people. Older folks, if we can figure out vaccines and whatnot, but older folks are going to want to be near where the action is. They don't want to go out in the burbs and watch the corn grow and watch paint dry and wait
right.
up. I mean, I think people want to be active, and they're going to continue to be active, and they're going to want to be around other people. We're social folks, and so I don't see everybody running out to the suburbs and wearing masks for the rest of their life.
Has anything, looking back over the last couple of months, has anything surprised you, Bill?
What surprised me probably the most is that our collections early on, everybody was just totally wigged out about what kind of collections were people going to pay rent at all. And at least in the multifamily space, in the A product in particular, we were very pleasantly surprised with how that's worked and operated so far. I've been surprised that construction lenders are still willing to close construction loans and start new deals now. Same thing with equity, because 2008 that didn't happen, and so that didn't freeze up. That surprised me again in a positive way. And leasing surprised me in a positive way. Leasing has been better than I thought. Now cancellations have been higher. That was a little surprising because what we found is as people lease online, the cancellations then are higher. They sign the lease and then they cancel it.
That's interesting.
So I've really been surprised more on the positive side than on the negative side anyway.
What do you think will catch people by surprise over the next 60 days?
I think one of the big things is going to be the psychological effect all of this has had on people that are home, not in the office. They're trying to, they're working the best they can, but they still can't avoid watching TV a lot. And they're getting bombarded constantly with how bad everything is and all the numbers. And I think people are just totally freaked out. It's going to take them a while to adjust. They're going to be afraid to go back to work. They're going to be afraid to go to the store. They're going to be terrified to go to a ball game or a movie theater again. So I think, that's going to be a much bigger adjustment than people are expecting. That they think, okay, when the states, and local governments say it's okay to go back to the office, it's okay to go to work, you can open businesses. I think there's going to be a pretty good lag time where a lot of people are going to be really freaked out. And there'll be other people that won't care. They just won't care at all. But there's going to be a lot of people that it's going to take a while for them to start behaving like they did in February. And I think that'll surprise a lot of people.
Well, we're going to leave it at that. Great thought to ponder and an opportunity to go back and revisit in a month or two and see which of these predictions came to fruition and whether this is going to be the surprise or another one. Bill, I want to thank you for taking the time to join me. It's been a great conversation, and I hope that you had as much fun as I did. I wish you and your family health and safety, and I hope that you and your colleagues at Mill Creek continue to do the excellent work you guys do. You are fulfilling a very important role in America and providing good quality housing for people that need it in the place when they need it is certainly a mission that we need to do more of. So thank you for that, and I look forward to talking to you soon.
Great, thank you, Gadi, and again, thank you for having me, and thank you for being a good friend. And your firm, as I said, you guys have been great to work with for many, many years, and we're better prepared, honestly, as a company for this because of a lot of the things that we've done with you and your group strategically over the decades. So thank you, and best to you and your family.
That's very nice of you to say. Very well. Take good care, Bill.
You too. Take care. Bye.